Today, I'm going to show you how you can start with $100 and build it up to $1,000, $10,000, $100,000, or even $1 million. I started with $100 and now I have a net worth of about $400,000, which does include equity in my home that my girlfriend and I own. Now I'm 30 right now, turning 31 in a couple days on June 15th, and I know that for my age, that's not a crazy amount, especially compared to the many other YouTubers you probably watch on here. However, I am happy with it because I actually didn't start that long ago, and the other thing is that a lot of it is actually money that has been made by my money, if that makes sense. For example, what I mean by that is here's one of my self-directed retirement investment accounts. And you can see that this particular account was opened at the end of 2018, and I've contributed about $43,000 to this account slowly over time. And it currently has a value of $128,000, which is a 223% total return, at least according to this report, which, if annualized, is about 50% per year. Now, I don't expect to be able to continue at 50% per year, of course not. And I know I'm getting a little ahead of myself here, so I'm gonna back it up a bit, but I wanted to show you this first so that you know that I'm walking the walk, so to speak. But nonetheless, I did start with less than $100 because one day I just said, screw it. I'm gonna start right now. Even though I don't know everything there is to know, I do know that investing is the right thing and getting my money working for me is the right thing to do. So I'm starting. And so if you've ever had $100 in your pocket and you've thought to yourself, how do I turn this into more? How do I make this work for me? Well, then you're in the right spot. Also, by the way, I don't have anything to sell at the end of this, so I'm not gonna hold anything back on you. I'll tell you exactly how I'm currently investing. I'll tell you how you can get started with less than $100 right now. And we're gonna go through the different types of investments that you could choose from, the pros and cons, and the riskiness level of each type. Now, I'm not a financial advisor, obviously. I'm just someone who's totally obsessed with investing and has read dozens and dozens of books on the subject from all different perspectives, and sharing what I've learned and what's working for me is just something that I'm really passionate about. And that's because I want to help people reach financial freedom earlier in life and help people to just feel better about their financial situation, knowing that there is a clear and visible end in sight to the dependence on your paycheck. Life becomes better when you can see that end in sight, and helping people move that finish line even closer is what I want to contribute to this world. Growing up, I always wanted to make a lot of money, and I always wanted to have a lot of money. I wanted to live the good life, travel, and do what I wanted. My focus was totally on how to make more money rather than investing at all. Investing was just something that I would do at some point in the future. Thankfully, I started learning about compound interest, and I realized that if I didn't get started immediately, then I'd be making a serious mistake. For example, I learned that starting with $100 and investing $100 a month, so in other words, $1,200 per year, and growing at a modest 10% per year, which by the way is what most people agree is roughly the annualized average return you'll get by simply just buying an S&P 500 index fund. And we'll talk more about what that means in a second. But after 30 years, it will have grown into $199,000. $36,100 would be the total contributed amount, and $163,000 would be investment gains. So that's not bad, but check this out now. If you started 5 years earlier, look at the drastic difference it makes. So the exact same thing, but instead of 30 years is 35 years, and your wealth has grown to $328,000. And remember, this is only $100 a month, which is like $3 a day. Anyways, the point is that it's about 65% more for just an additional 5 years. $42,100 would be the total contributed amount, and $285,000 would be the investment gains. And what I realized from playing around with a basic compound interest calculator like this one is that it wasn't the initial contribution amounts or the additional contribution amounts that mattered most to get the largest final result, but it was actually the duration and the annual returns that mattered more than anything. So that's the strategy: maximize the duration and maximize annual returns. And that's why when people ask someone like Warren Buffett, one of the richest people in the world who got there by investing, when they ask him, how do you get rich? The first thing he says is to start young. He bought his first stock at age 11. Now, it wasn't until he was actually around 19 or 20 years old that he actually learned how to do it properly, but still. Now, in addition to starting young, he learned more about how to find nice bargains in the stock market so that he could buy stocks at a discount, which meant that he was able to maximize his annual growth rate. To give you an idea of what I mean by that, look what happens if we take our exact same example, but instead we increase the annual growth rate to 12%. Our final result becomes $523,000. So another significant increase of about 60% from just a couple of extra percentage points of annual growth. That's pretty amazing, right? And that's another reason, by the way, to avoid paying fees to a financial advisor or an expense ratio on a mutual fund, because those fees can often be 1, 2, or even 3% or higher, and those annual fees will absolutely guesstimate the future value of your investments. I'm going to briefly come back to that point in a little bit, but nonetheless, I believe 12% a year is very possible to achieve, and we will get into how in just a little bit. But the main thing to take away from this section is that even above annual growth rate, the most important thing is time duration. And the least important thing is that initial amount you're starting with. So the best time to get started investing is always going to be right now. And with that said, let's back it up a bit. We're going to talk about the different types of investment options that you can start with. The first option is to just put your money into a savings account. According to bankrate.com, the best you can get is not even 1% right now. And in Canada, it looks like it's possible to get about 1.25%. If we plug that into our compound interest calculator, we can see that the result isn't too exciting. Around $52,000 after 35 years. Now, a lot of people would consider this a low risk investment, but I actually consider it to be the highest risk investment that you can make. And I say that because it's an investment which virtually guarantees loss of purchasing power. And that's because of something called inflation. So although the numerical amount of your money will increase over time, its value will be less. $52,000 in 35 years from now will have the same purchasing power of about what $26,000 has today. And that's if inflation is only 2% annually. According to trading economics, the inflation rate is closer to 3 or 4%, which would make that $52,000 you would have in 35 years from now have the equivalent purchasing power of about what only $13,000 has today. Now, this video isn't about inflation, but it's an important fact of life that we need to consider when it comes to investing. And that's why I call putting your money into a savings account a high risk investment, because it's an investment which basically guarantees loss of purchasing power. So for the savings account, we're actually going to put that into the category of high risk, low return. So in other words, stay away. And obviously if you're putting your money under the mattress or in a piggy bank at home, that's even worse. Now, the next one worth mentioning is residential real estate, or in other words, rental properties. But the problem though is that we're talking about how to get started with $100. So that one's just off the list because of that. But there's actually a way to invest in real estate, even if you have less than $100, through buying something called a REIT. REITs are a publicly traded vehicle which owns real estate. The real estate earns rental income, and that rental income gets distributed to all the REIT shareholders proportionately to their percentage of ownership in the REIT. And by the way, REIT stands for Real Estate Investment Trust. And for a REIT to be considered a REIT, it must invest at least 75% of total assets in real estate, cash, or US treasuries, derive at least 75% of gross income from rents, interest on mortgages that finance real property or real estate sales, and pay out a minimum of 90% of taxable income in the form of shareholder dividends each year. Let's just dive in and look at an example. Morguard North American Residential REIT, which trades under the ticker symbol MRG.UN if you're in Canada, or MNARF if you're in America, is a REIT which owns 12,255 units across 43 multi-unit residential properties within America and Canada, 27 US residential apartment communities, and 16 Canadian residential apartment communities. And here's the list of the actual properties, the percentage of that property owned by the REIT, and the number of units. As of March 31st, they had a 94% occupancy rate, so that means only 6% of the units are vacant and without a tenant inside. Now, REITs are cool because it allows you to own real estate and collect monthly rental income through the distributions without needing to manage a property or deal with tenants yourself at all. This particular REIT has a 4.1% dividend yield currently, which means that for every $100 worth of shares in this REIT that you buy, you'll receive $4.10 per year. Divided by 12, that equals about 34 cents a month if you invest $100 right now. And of course, the more you invest, the more your monthly distribution will increase. And to tap into the magic of compounding growth like we've been talking about, you're gonna wanna reinvest all that money that gets distributed to you as well. So after a year of investing $100 a month, you'll have $1,200 invested, and if you've been investing the money that's being distributed to you every month as well, you'll have roughly $1,223 total invested. Not bad. $1,223 worth of this particular REIT will give you about $50.14 per year, which means about $4.18 every month. Now, that might not seem like a lot, but eventually, if you keep investing and reinvesting, that will definitely grow over time. Now, a couple things to note. First, 4.1% is just the dividend yield right now. So if everyone decides that they love this REIT and everyone starts buying it up, then that would cause the share price to go up. And when the price is higher, it means that continuing to buy shares of that REIT would mean that you have to pay more for the same dividend distribution amount, which means that the dividend yield will be lower. So the 4.1% dividend yield isn't a fixed number. It is always going to be fluctuating as price fluctuates and as the dividend distribution amount changes as well. Also, it's important to remember that although 4.1% is the dividend yield, this isn't what your overall investment annual growth rate will be limited to. And that's because the value of the properties owned by the REIT will increase in value over time as well, and that increase in value will be reflected in the share price over time as well. So as an owner of the shares, you'll benefit both from the dividend income that you'll be receiving on a monthly basis and from the share appreciation. The value of your shares will go up. At least that's what will happen in the long run. However, in the short run, they can sometimes go down, but that also can mean a good opportunity to buy more shares at a discounted price. This chart here shows REIT average annualized rolling 20-year returns compared to that of investing in US stocks. So it's telling us that REITs actually outperform stocks for one thing, which is interesting. And now there's many ways you can look at data to extrapolate the meaning that you want from it. So I'm not telling you that this is the truth and that REITs are better than stocks. And as you'll learn in a second, I don't own any REITs myself because I actually prefer to own stocks instead. But the reason for showing you this now is just to show you that your annual returns come from more than just the dividend yield. 9 to 12% annually is about what you're looking at based on historical data and depending on when you're buying, and we'll talk more about that in a bit. One word of caution about REITs, by the way, is that solely looking for the REIT which has the best dividend yield is not the best idea because there's more to it than just that, and it would be a mistake to approach picking REITs in this way. I could do a whole video on how to pick REITs, and if you'd like me to make that video, let me know in the comments. But in a second, I'm gonna tell you a way to invest in REITs without needing to know which ones are the best ones to buy at any given moment. But first, I'm gonna explain something to you now about how it all works that's gonna be pretty exciting to learn. So when you own shares of a REIT, it means that you actually legally own a percentage of everything that that REIT owns. So you and the millions of other shareholders are the owners. The owners of all that real estate. And the people who actually do the work and collect the rent and maintain the properties, etc., are technically considered your employees. That's right. And when there's big decisions that need to be made, you as one of the owners actually vote on what you choose for those decisions along with the other owners. You'll literally get a little voting card in the mail sent to you to mark down your vote and then mail back. And that'll happen even if you only own one single share. You're an owner. And your wishes, what you vote on and agree on as the owners, will be what gets carried out by the management team, your employees. Pretty cool, right? Is it making sense why owning assets like rental properties or businesses really just makes sense? And just to be clear, you can actually calculate what your ownership percentage of everything actually is. For example, with the REIT we've been talking about here, they have 39 million total shares. So if you owned 100 of those shares, you would mathematically be about a 0.00025% owner. Does that make sense? Isn't that cool? It's kind of like if you and 4 friends bought a rental property together and you each pitched in an equal amount and you all shared the rental income it generated equally as well. With REITs, it's the same, but instead of it being 5 people in total, it's millions or even billions in some cases, and instead of owning 20% of one property, you own a much smaller percentage of a whole portfolio of properties. It's awesome, right? So REITs are a great way to invest in real estate, even if you have very little money. And of course, you don't have to deal with tenants or managing the property at all, which is a nice bonus. Completely passive income is the best kind of income. And because most people understand how real estate investing works, REITs are a good one for most people. It will get your money working for you and compounding away at a very acceptable rate, and you can literally get started with it right now. And I'm going to talk about how you can actually get started right now shortly, but a natural question you might be having right now might be, how do I know which REIT is the best REIT to buy right now? And how do I know which REIT is going to be the best one to buy at any given moment in the future? Like, should you go ahead and buy the one I just mentioned in this example, or is there another one that would actually be a better buy right now? And again, I could do a whole video on how to pick the best REIT at any given moment, so let me know if you'd like to see that. But one easy solution is just to buy all of them. And I'm going to use that as a way to segue into talking about the next investment type that I want to cover, which is exchange traded funds, or ETFs for short. Exchange traded funds are funds which you can freely buy and sell shares of on the stock exchange. So just like you can buy shares of REITs or shares of a company's stock, you can also buy shares of exchange traded funds in the exact same way. There's all kinds of funds. There could be a fund, for example, which owns bank stocks. And so if you wanted to invest in banks, instead of buying shares of each of the bank's stock individually, you could buy shares of an exchange traded fund which owns bank stocks. So you would own the bank stocks through your ownership of the fund. Does that make sense? So one of the types of funds out there for us is a REIT fund. And as you might have guessed, REIT funds own REITs. The Vanguard Real Estate ETF, which you can look up under the ticker symbol VNQ, is one of these types of funds. It has a per share price of $104 right now, which by the way does not need to be an issue for you though if you're working with less than $100, as long as your broker allows you to buy fractional shares. And we're going to cover that more in a second. Its dividend yield is currently 3.13%, so not bad. And we can see here that it has 175 REIT holdings within it. And this list here just shows the top 15. Now the REIT that we looked at earlier was strictly a residential REIT, but this fund of REITs actually holds all types of REITs. This one here, for example, Public Storage, is a REIT which owns self-storage facilities. And on their website, we can see that they have 2,500 self-storage facilities across the United States. And if you wanted to buy shares of this REIT directly, you could look it up under the ticker symbol PSA and do so. And when it comes to exchange traded funds, ETFs, one thing to make sure you look at is what's called the fund's expense ratio. This Vanguard Real Estate ETF has an expense ratio of 0.12%. And this means that for every $100 invested, you'll be paying 12 cents in fees annually. These fees go to the fund management company, which in this case is Vanguard, so they can carry out with the buying and selling of shares within the fund. 0.12% is considered a low expense ratio, especially when expense ratios can be as high as 1, 2, or even 3% annually. Bottom line is that buying shares in an exchange traded fund like the Vanguard Real Estate ETF is an easy way to spread your money across a whole bunch of REITs rather than needing to pick and choose which specific REITs are the best ones to buy and which ones are not. In other words, it's a good way to diversify. And diversification like this is just a way to not put all your eggs in one basket, as they say. Buying a REIT ETF is essentially like saying, I don't know which ones are the best ones to buy right now, but I do know that I want to be invested in real estate in general because I think property values will continue to rise and I think rents will continue to get collected and rents will continue to increase over time as well. So what I'm going to do is I'm going to just buy a little bit of all of them. That's what it means to buy a REIT ETF. Now the cool thing about ETFs in general is that through them, you can literally own a small percentage of billions and billions and even trillions of dollars worth of income producing assets. That's cool, right? So if you want to get started getting your money working for you right away and not have to pick and choose which individual stocks or individual REITs are the best ones to invest in, exchange traded funds are the best way to go. And that's even what Warren Buffett says that most people should be doing instead of picking and choosing for themselves which ones to buy. Now when it comes to ETFs, there's two categories of them: actively managed funds and passively managed funds. Actively managed funds have fund managers that are actively picking which stocks or REITs to either include or exclude within the fund and buying and selling them as they feel best, with the ultimate goal of being to maximize the fund's annual investment returns. So buying an actively managed fund is kind of like saying, I want that guy to pick stocks and REITs for me. But these actively managed funds usually come with those high expense ratios of 1, 2, or 3%. And the dirty little secret of Wall Street is that something like 80% of them, or maybe even more, don't actually perform any better than the passively managed funds, which have the minimal expense ratios. A little over 10 years ago, Warren Buffett actually made $1 million bet. And the bet was that a simple low expense ratio S&P 500 index fund would actually outperform a hand-picked portfolio of hedge funds over a 10-year period. Essentially a bet on passive investing versus active investing. Anyways, someone took him up on the bet, and of course, Warren Buffett won the $1 million bet. The conclusion and other data and statistics show that you're better off passing on the actively managed funds and going with a passively managed low expense ratio index fund instead. If you want to learn more about index funds, check out this video right here. Two of the most popular ones are the Vanguard S&P 500 Index Fund VOO and the Vanguard Total Stock Market Index Fund VTI. Through owning shares of these funds, you'll have ownership in hundreds of companies, and for a next to nothing expense ratio. Buying shares of an S&P 500 low-cost index fund like VOO on a regular basis consistently is actually exactly what Warren Buffett suggests that most people do. And for what it's worth, I agree with him. On that note, I also did a video on the subject of dollar cost averaging versus waiting to buy stocks at the exact perfect time. And in that video, I compared the results of somebody who's just simply put the same amount in every month on autopilot compared to the results of someone who had absolutely perfect market timing. And the results were actually shocking even to me. So check that one out right here. So the next investment type that we're going to talk about that you could choose on your path of getting your money to work for you and getting it compounding for you is actually to pick individual stocks yourself. Picking individual stocks is what I do, and it is what Warren Buffett does, and that's even though he suggests that most people do just buy low-cost index funds. And it's what I think is the best way to maximize the annual growth rate that you're compounding your money at if you're willing to put in a little bit of extra time and effort. Now it's funny because I just finished telling you that the professional money managers, those actively managed fund managers, can't outperform passive index funds that just simply track the market. And so if the professionals can't beat the market, then how can we expect to? And there's a few reasons we can. And there's a few disadvantages that the big money managers have that we don't, which makes it possible. And I go into that in more detail in this video right here. Nonetheless, this is for the high achievers who actually want to maximize their annual investment growth rate, but it will require you to learn quite a bit more and to put in some time and some work into researching companies. Now, one mistake that I see people making with this one is that they want to get those high returns that are possible, but they don't want to do any of the work. So what ends up happening is they go onto Facebook or they go onto YouTube to find what somebody else says is the best stock to buy right now, and the whole thing quickly becomes a lot like gambling. And if done that way, this way of investing actually becomes the most risky choice of all of them. So if you're not ready to go deep into learning about how to pick stocks, which by the way has nothing to do with interpreting price charts or using technical analysis, then I would just encourage you to stick with the low-cost index funds. Speaking of risk though, the cool thing about picking stocks yourself is that if you learn how to do it right, the risk actually goes way down. Some would even make an argument that if done right, it's even less risky than index fund investing. And that's because when you're doing it right, you're actually buying shares of stock at a discount to what they're worth. And the larger the discount you get, the larger the margin of safety that you'll have. And also, the larger the discount you get, the larger your investment returns will be as well. Pretty cool, right? Low risk, high return, that's like the holy grail of investing. And that's why buying individual stocks, if done right, is so cool and can be so rewarding. So if you want to get started right now, I would suggest every time you get paid from your employer, put $100 or even just $10 to start, put that into your brokerage account, and then buy shares of something. To start off, go with a low-cost index fund like VOO or VTI, or maybe even the real estate one we talked about earlier, VNQ, if you like real estate. And then literally just make a habit out of it. And if you can, even automate the whole thing so it just happens without you even needing to think about it at all. The biggest thing is just getting started and making it a habit. And if you want to learn more about how to pick individual stocks from there, you can. And if you find out that you don't actually have any time for that right now, well then at least you'll be making good progress in the meantime, and without any time or effort needing to be dedicated to it. Your first investment ever does not need to be your best investment ever. This is not something that you try to become an expert at first before even starting. Warren Buffett says that he continued to become a better and better investor long after becoming a multi-billionaire. So if you're waiting to be an expert before even starting, then you're just never going to start, and we've seen how detrimental that can be. And you can also always change things along the way as you learn more. That's what I did. But the important thing is just to get started. Because if you don't, then you're going to be stuck trading your time for your money forever with no end in sight. And I don't want that for you. At least if you get started, there will be an end in sight. Even if it's far in the future, it's there. So the next step for you now is to choose a broker and make an account with them. Now, I'd suggest choosing a broker that offers fractional shares. This way you can buy shares of REITs or companies or ETFs even if the share price is high. A lot of companies have share prices of $100 or $200 or $300 or even more for a single share. One of the stocks that I own actually costs $4,838 for one share. With fractional shares, you can buy a fraction of a share, or in other words, a partial share, and this will really open up your options and make it so you're not restricted at all, even if you have less than $100 to start. This table here from thebalance.com lists brokerages that do offer fractional share investing. Now, I use Interactive Brokers myself, but I've heard great things about M1 Finance, and I think that's where I'd suggest most people start. I've also heard great things about Fidelity as well. Now, if you're a Canadian and watching this, fractional shares only seems to be available through Interactive Brokers. I think Interactive Brokers might be a little bit more complicated than some of the other platforms, but it's not that bad. Remember too that you're not set in stone with which broker you choose. You can always open an account with another broker later. Myself, I have accounts with 2 different brokers, so it's not a big deal. And you don't need to worry about having everything with the same one. It's not a big deal. The big deal is getting started right now. You can also always do a complete position transfer from one broker to another, so it's very flexible. The important thing is getting started right now and getting your money working for you and compounding for you. So that's your homework. And yeah, I know it's funny, some guy on YouTube is giving you homework, but if you haven't bought a single share of anything yet, ever, then pick one of the brokers that offer fractional shares, open an account with them, fund your account, and then buy something. Literally anything. And in order to not get caught up in that detail, just follow Warren Buffett's advice and buy a share of the S&P 500 Index Fund, VOO. That way you'll finally be actually in the game, and you'll be in the game of making your money work for you. Now, by the way, I just want to say that if you're in Canada, the VOO and the VTI are not going to be the best ones because it would require you to convert your Canadian currency into US currency in order to buy it. And usually that conversion comes along with a currency conversion fee, which you're going to want to avoid. So what you're going to want to do is you're going to want to look for basically the same types of funds that are listed on the Canadian Stock Exchange. Don't forget to like this video, share it with somebody that you think will benefit from it, subscribe with notifications on, and check out this video right here next if you want to keep learning. I think this one's going to be really important for you to see, so I'll see you over there.